You know what? Today a client of mine asked me something real interesting. He said,
Hey Jill, I'll be receiving my Diwali bonus and variable pay soon. I've tried every kind of fund as suggested by you. Equity, hybrid, even international. But I feel markets are so unpredictable. Is there anything that works in both rising and falling markets?
wait, what? Something that works in both rising and falling markets. And honestly, that's the question almost every investor is asking right now. Because let's face it, markets go up, markets crash, and we all wish our portfolio just stays green, right? What if there actually exists a product that earns in both directions? That is, to grow when the markets rise and protect when they fall. Welcome to India's newest investment innovation, the Specialized Investment Fund or SIF.
Oh Jill, one more acronym?
Hold on, let me explain. SIF stands for Specialized Investment Fund, a brand new SEBI-approved category under mutual funds launched in 2025. It's designed for investors who want diversified, strategy-driven exposure, something more flexible than the traditional mutual funds, but still regulated, transparent, and professionally managed. Think of it as an evolution, mutual funds 2.0, built to handle both volatility and opportunity. Unlike traditional schemes, SIFs allow fund managers to run specialized strategies like long-short equity, derivatives-based hedging, or tactical asset allocation, all within the mutual funds framework. This means they can take defensive or aggressive position depending on market conditions. So, instead of just buying stocks and holding them, SIFs can also protect returns when the market turns volatile. Confusing? Understand it like a product which sits right between mutual funds and PMS, portfolio management services. Now, why in between? Because in a mutual fund, you can invest any amount, 500, 1000, 10,000 and so on. In PMS, you need a minimum of 50 lakh rupees. In AIF, the minimum amount is 1 crore. But many investors have investable funds, say 10 lakh or 15 lakh, but not 50 lakhs or 1 crore. For such investors, this new category is launched, where the minimum investable amount is 10 lakh rupees. Now, let's talk about taxation for investors. The taxation structure for SIF is the same as that of mutual funds. For equity, short-term capital gain will be at 20% in case of redemption before 12 months and long-term capital gain at 12.5% after 12 months. For debt, the taxation will be as per the tax slab rates. For PMS, investors are taxed at each transaction level. For AIF, no taxation to investor considering it's a category 3 AIF. Coming to taxation and fund house level, under SIF and mutual fund, the fund houses are exempted under section 1023D, having a pass-through status. Under PMS, no taxation for PMS companies. Under AIF, they are charged a hefty 42.7% tax, including cess and surcharge. No leverage is permitted under SIF, mutual fund and PMS. However, it is permitted to AIFs with gross exposure up to 200%. In SIF, short exposure through unhedged derivatives is allowed up to 25% and derivatives for hedging and rebalancing is allowed in all three, SIF, mutual fund and PMS. Now let's simplify the categories of SIF. There are mainly three categories: equity, debt and hybrid. Each AMC can launch only one SIF per subcategory, and there are a total of 7 subcategories across equity, debt and hybrid types. So, if it's SBI AMC, then at any point of time, SBI AMC shall have only 7 SIF products, and your investable amount of rupees 10 lakh can be spread across these 7 products with one AMC. In our example, that's SBI AMC. Now let's understand the equity SIF categories first. First, equity long short. Here the fund manager can go long, buying with the view that the prices will rise, and short, selling first and buying later to profit from a fall. At any point of time, minimum of 80% investment must be in equities. He can short up to 25% of total portfolio. This allows the manager to make gains even in falling markets through strategic shorting. Second is equity X top 100 long short. As the name suggests, this fund invests in equities excluding the top 100 companies by market capitalization. The manager here must invest at least 65% in mid and small cap stocks. He can also short up to 25% of the total portfolio. Third, sector rotation long short. Here, the fund manager focuses on specific sectors, for example, IT, banking, pharma, etc. The manager here should make sure that minimum 80% of total exposure must be across only 4 sectors, not more. Within each sector, shorting is allowed up to 25% of that sector's exposure, not total portfolio. These 3 categories cater to different investor preference. Long short for core equity exposure, X top 100 for mid and small focus, sector rotation for tactical sector calls. Now, let's move to debt SIF categories. Debt SIF. Here too, long and short positions are allowed. Shorting may sound a little unusual in debt, but it's used when the interest rates are expected to rise. Since rising rates reduce the bond value, here as well, you can short up to 25% of total exposure. Debt SIFs can be sector specific, investing mainly in a single fixed income sector. Now, let's understand hybrid SIF categories. First, active asset allocator long short. Here, the fund manager can invest in any asset class, equity, debt, derivatives, REITs, InvITs, commodities, gold, silver, anything. Also, the allocation can be shifted dynamically. For instance, 100% to silver one day, 100% to debt the other day, completely flexible. Second is hybrid long short. Here, the fund must have at least 25% in equity and 25% in debt. And shorting across portfolios should not be more than 25%. Now comes the big question. Who should invest? So, is SIF for you? Let's run a quick profile check. Be honest with yourself. First, you already have a core portfolio of mutual funds and index funds. This means you have got your foundational long-term investments sorted. SIFs are typically for adding a layer of strategic alpha through equity strategies or to get predictable returns with less volatility through hybrid strategies. And so, they are not for your entire portfolio. Second, you have tasted derivatives. If terms like futures, options, call, put, hedging make your head spin, SIFs might be a little too advanced for you now. Third, you can stomach weekly liquidity, not daily. You understand that you cannot just pull your money out on a whim every single day. This implies a slightly longer term view and acceptance of less frequent redemption. Though you can withdraw funds through a systematic withdrawal plan, SWP, but the only condition is that at any point of time, your investment should not reduce below 10 lakhs. Fourth, a rupee 10 lakh ticket size. If this is under 15% of your liquid net worth, if it locks up for a year, you still slip fine. Now this is crucial, as you cannot redeem partial amount and go below the limit of 10 lakh. In that case, you will need to fully exit. So this 10 lakh should not be your emergency fund or some money that you need in the short term. It's that part of capital that you can comfortably allocate without losing your sleep. If you ticked 4 out of 4, then yes, SIF absolutely deserves a serious look. Start digging into early offerings. If you didn't, or if you felt uncomfortable with any of these 4 points, then honestly, stick to building your core portfolio first, know your risk tolerance, and invest accordingly. If you fit the profile, can relate to the SIF strategies and grasp the complexities, SIFs present an exciting new frontier. If not, there is absolutely no need for FOMO. A well-diversified, low-cost mutual fund portfolio remains one of the best strategies for long-term wealth creation. Check with your investment advisor and take the decision accordingly. So tell me, what are your thoughts on SIFs? Let me know in the comment section. If this video has helped you, hit the like button, share it with someone whom you know and whom you think will benefit as well. And don't forget to subscribe for more simple smart money insights. Happy investing!